Hello, hello. In this channel, I have always been warning investors to be super careful about these companies that are really trending and they're not making money. One such company is Carvana, for which again I have made a video in the past telling you that it's a very risky proposition. And today it was actually down 43% on a potentially high bankruptcy risk. In this video, we will examine whether the company will potentially go bankrupt and what happened during the market hours and whether this insane drop potentially is a good opportunity for buying the company. Now, this company is down almost 99% from its one-year high, which is insane. Take a look at where it was. You can kind of see how crazy this market is. Valuing this company at $274 when its P ratio is negative, for example, is insane, absolutely insane. But let's take a little bit of a look at what happened. It crashed over 40% amid rising bankruptcy risk. So what was the deal here? Why the 40% crash? According to Bloomberg, the online auto retailer's 10 largest creditors signed an agreement to present a united front in restructuring negotiations in order to avoid bickering amongst themselves in restructuring negotiations. And you will see that combined with the fact that many bonds of the company have been trading at 50 cents on the dollar, which is obviously super high, indicating investors see a high probability of default, of a bankruptcy. This is why there is a negative risk here, and this is why the stock went down that much today, more than 40%. So it looks like the company has a lot of debt, doesn't really make enough money to sustain those payments, and it may be in for a bankruptcy, is what this article is basically pointing out here. And if you take a look at the financials of the company, which is up just a measly 2% after hours, again, be super careful about buying here. You will see that their metrics here are pretty horrible. The P ratio is negative and has been negative for a while, even more. Now it's a little bit better, but still pretty negative. And the price to free cash flow is also negative, getting a little bit better, but still in negative territory. With the amount of outstanding shares being in absolute incline here, although I guess the past couple of years they have been buying back some shares, but overall they have been printing a ton of shares, 600% more. Again, they were buying back some, which is a good sign, but as a whole, the company has been printing shares like crazy, pretty much funding themselves through investors buying the stock, which is obviously not great if you bought over here or here. It's pretty horrible. And in terms of the revenue growth, the company has been increasing the revenue, so it's not like they're not selling stuff. But the problem is, take a look at this net income, and the free cash flow over here is basically getting more and more negative, is the big problem. And it's only because the stock is crashing that the P ratio is higher than it used to be when it was like minus 200. But it's not coming from the operations. It's a big problem, because the company, again, it's still losing profit, still losing free cash flow. Terrible picture here. And in terms of the total equity, it's only going up because of the outstanding shares that the company has been printing during these years, pretty much. Now it's going down again because the company was buying back some. And again, the margins are negative, return on equity is negative. The company is not making money here, is a big problem. And if you take a little bit of a closer look at the income statement, for instance, of the company, you will see that, they are increasing their revenue at a very nice pace here, tremendously increasing their revenue. But take a look at the net income. This is problematic. Even though they are increasing their revenue, they are staying at the same level, and if not losing money here. So they are still really not making money. A lot of expenses, it looks like, and they cannot really become positive in terms of the money that they are making. It's just their EBITDA is positive, but still their net income is negative. And the balance sheet, as you will see, over here is something that you would expect. The fact that the company has been pretty much spending some capital for buying shares. Now again, they are buying back some shares, but they used to issue a lot. And in terms of the total equity of the company, they have about $500 million over here. Again, they used to have 800. They're buying some back, I suppose. So this is why this is probably going down. And in terms of the cash flow statement, again, it's a negative picture because the net income of the company is very negative, from losing 18 million to losing 135 million. And if you convert this to operating cash flow, it's actually a loss of 2.5 billion, 2.6 almost, because of the depreciation, amortization added back. And also there are massive changes in working capital and inventory here. meaning that they basically, for instance, for the inventory, they basically spent $2 billion of cash in order to add some extra inventory here. So it looks like they are selling stuff, but again, the problem is that they're actually losing money, and they keep losing money for a while now. As you'll see, their free cash flow is minus 3 billion, and it used to be minus 200 million, so much more expenses over here. So you would want this to be the opposite way. You would want this to be 2017 and this to be today. And so this is very problematic, a very problematic picture. Take a look at this over here. It's actually down minus 200% from its last year free cash flow. This is not a great picture to see. And if you take a look at, of course, our stock evaluation tool with our stock evaluator over here, which is patrons have full access to, of course. And if you are interested in becoming a patron, you can find the link in the description box below this video. You will see that the revenue growth of the company has been tremendous, but take a look at the margins here that the tool gives you the averages. And the averages of the free cash flow margin are just positive here because they are coming from two negative values. So negative net income and negative pretty much free cash flow is what makes it positive, but it's not actually positive because it's coming from negative profitability. So if we try revenue growth that is pretty high, very high even, 30, 40 and 50, this is almost impossible to continue happening for, although you never know, in the next 5 years it could. But let's just say this happens. The net income margins of the company are negative. Now they are getting a little bit better, it looks like lately, but they are still negative. Now we have to assume some marginal profitability. I would go with 1.5 and 2, because otherwise it doesn't make sense to be buying at all. We need to see that the company is actually turning some profit. Otherwise, why would you buy a company? Now, the free cash flow margins over here are all over the place, as I told you earlier. That's because of the net income being negative and the free cash flow being negative. So when you generate the margin of the free cash flow and the net income, you get a positive number. But frankly speaking, because it's coming from negative net income, you cannot really be using these values. Instead, you have to go with something that the company could potentially achieve when it reaches profitability, which typically we go for 80, 90, and 100%. That would make some sense. And in terms of the annual return, 13%, you could ask for more here. It's a very risky company. Now, if we hit calculate, you will see that we're getting tremendously high values, and this is to be expected for a very important reason. The company has been extremely bust, the stock price is down significantly, and we are assuming profitability. And because the company has been bust so much and we are assuming marginal profitability, it tells us that this company, if it gets to marginal profitability, could actually be an interesting opportunity. But there is a big but here. It's very risky. So because the company is having a lot of debt, and we also learned about the creditors today, and it's down significantly, there is risk here. So buying this one, would require, accepting a fairly large risk for a potentially high opportunity. Now, this company has some potential for bankruptcy as well, and in that case, you would be losing your money. But if they manage to turn it around, if they manage to secure some funds and become net income positive eventually, then they could turn it around. But 50 cents on the dollar for bonds, that's absolutely insane. So we're looking at very high debt over here, and a lot of leverage for the company, which indicates high risk, much higher risk than you would potentially want. So if you are looking to invest in this one for a lottery ticket type of investment, make sure that you go with money that you are fine to potentially lose, because there is a probability of that, and potentially a higher probability actually. But the tool here does tell you that if the company actually manages to reverse course and achieve marginal profitability, granted, this revenue growth is insane. Even if I went with lower one, 10, 15, and 20, which the company could easily achieve, we are still going to be in the green comfortably, again, because the company is bust so much and because they are not terrible in terms of the money that they are making. So the stock price is down so much that it becomes a potentially interesting opportunity if the company changes the things, turns the course around, and actually manages to become net income positive before bankrupting. So again, a very risky one. Make sure that you know what you are dealing with. And thank you for watching this one. And I'll see you in the very next video. Stick around because there's going to be quite a few more videos today and tomorrow. Interesting companies to examine. And I'll see you very soon. Bye-bye.